Right, welcome to our third live session for the revision sessions, and tonight's plan is to go over the capital gains. Now, I know that a few of you have already done your mock exams, so I hope you've enjoyed doing your mock exams and it went well. Going back to the study planner that we have planned for today, the plan for tonight is to look at capital gains tax. And in capital gains tax, what I will be doing is we'll be going over capital gains for individuals and then capital gains for companies. So what I plan on doing is looking at capital gains for individuals, looking at our computation, how we calculate the capital gains, and of course how we calculate the taxes for individuals. And after that, we will be looking at how we do exactly the same for companies. So now, as I said, I had already started the session, except that it wasn't being aired live. So I started with talking about the capital gains tax computation. And we're going to be looking at the capital gains for individuals. Now, I have already written it out because I thought the session had already started. So instead of writing it out again, I'll just simply talk it through to you. So when we prepare the capital gains tax computation for individuals, the first step is to calculate the gain. The gain is calculated by taking the sales proceeds, which is the disposal proceeds, less any selling costs. Selling costs are basically any cost that the seller may have incurred to sell the item, for instance, legal and professional fees. Once we deduct the selling costs, we then get the net sales proceeds. From the net sales proceeds, we deduct allowable expenses. The first allowable expense we have is acquisition cost and any incidental cost of acquisition. Acquisition cost is the cost of buying the asset, and incidental cost of acquisition are costs that are incurred when we buy the asset, for instance, legal and professional fees. Okay. The next allowable expenditure we can have is enhancement costs. So, for instance, having any extension done to the property or having any enhancement done to the property. Notice that this does not include repairs. Here, the enhancement costs are capital costs. The costs have to be capital in their nature. Okay. Once we calculate this, once we deduct this, we get the capital gain on the disposal. Now, although this is step one of the computation, and step one of the computation is to calculate the gain. However, what you will see is that we can have a variation in step one. Okay, so I'm just going to mention the different variations that we can have for step one. The first variation we can have is something known as a part disposal. Part disposal is where we dispose part of the asset that we own. For instance, we own 5 acres of land and we're only selling 1 acre of that land. The variation that you will get with part disposal is to find out the cost that is attached to the part that we're disposing. And in order to find the cost for the part that we're disposing, we use the apportionment method using the market value of the asset as a basis of apportionment. And that is what A divided by A plus B is. The second variation we can have with step one is, of course, to do with chattels. Okay. With chattels, you can have some wasting chattels or non-wasting chattels. Wasting chattels are exempt. Non-wasting chattels depends on their sales proceeds and their cost. If the sales proceeds of the chattel is less than 6,000 and the cost was also less than 6,000, then the chattel is an exempt disposal. But if, on the other hand, the chattel cost more than £6,000 and it was sold for more than £6,000, then you will use a normal computation. The issue comes in when one of them is under 6. So for instance, we buy a painting for £4,000 and we sell it for £10,000. What you see here is that the sales proceeds is more than 10 and there's a gain there. But on the other hand, you could have it the other way around. You buy a painting for 15,000 and maybe the market value of this painting falls and you can only sell it for 2,000. So you find in this case the sales proceeds is less than 6 and therefore resulting into a loss. So the treatment of chattels is another variation that we can get. The third variation we can get in step 1 is to do with shares. When you have shares, there are two complications. In fact, before I can talk about shares, the next variation is when there's a gift. When there's a gift of an asset, it is known as a deemed disposal at market value. So even though the individual will be giving a gift of an asset and he's not receiving any cash in return, he'll be treated as if he sold the asset at market value. And the same would be the scenario if he sells the item at less than market value. When you have a sale which is at less than market value, this is known as a sale at an undervalue. A sale at an undervalue is treated as a gift, and a gift is deemed disposal at market value. Okay. The next variation in step 1 is, of course, as I mentioned, shares. Okay. When you have shares that are being disposed, with shares you can have two issues that can come in. First of all, if it's a gift of shares. If it's a gift of shares, then that means we need to find the market value of the shares. Now, the market value of the shares is quite different from the market value of any other asset, because market value of shares is quite volatile. And it's different from any other assets. For instance, a building will have the same market value in the morning and it'll have the same market value in the evening. There's not going to be a change as such. However, when you look at shares, the market value of shares change in a matter of minutes, let alone the entire day. So that's why when you have a gift of shares, to find the market value of the shares, we use the quota up method and the average bargain method. The other issue we can have with shares is a disposal of part of the shareholding, which was acquired at different dates. If you've got shares that were acquired at different dates, they will have been acquired at different costs as well. So you may have had some shares that were bought on different dates, and for that what we use is known as matching rules. We use the matching rules to determine the cost of the shares that we are disposing. Now, for individuals, because we're talking about individuals here, okay, because we're talking about the individual, for individuals, the matching rules are to use the cost of shares acquired on the same day, to use the cost of shares acquired in the next 30 days, and to use the share pool. Okay, so this is the fourth variation, and the fifth variation that we can get in step 1 is a transfer between spouses and civil partners. When you have a transfer between spouses and civil partners, this is regarded as a deemed disposal at cost. Notice this is different from the gift. Gift is a deemed disposal at market value, and transfer between the spouses is a deemed disposal at cost. So in other words, no gain, no loss. Okay, so this is step 1 of our calculations.